If you're watching this video, then you must have an investment banking interview coming very soon, or you must be someone who's preparing for an investment banking role. So guys, you have found the perfect video. In this video, we'll be discussing about the top 10 investment banking interview questions along with their answers. But we won't just stop there. We'll also explain why each question is actually asked by the interviewer and how can you frame your own answer for that question. To make things easier, you can navigate through the question using the timestamp in the video, and we'll also attach a Word file with all of these questions, answer and the exact way to answer them in their own description. Now let's dive into the video. Hello guys, this is Ganesh Nayak, founder of Fintelligents, where we help students prepare for professional certifications like FRM, CFA and SCR. Now let us start with this video with the first question. This question is asked in almost every interview, whether it's in investment banking or any other role. It is an opportunity for the interviewer to assess your ability to present your professional journey clearly and concisely. They want to understand your career progression, your key accomplishment, and how your experiences have prepared you for an investment banking role. When answering this question, start with a brief introduction about your education, especially if you've studied finance, economics, or business. Then talk about your relevant internships or work experience. Highlight the key moments that led you into the investment banking, like a particular internship or a project where you have demonstrated a strong analytical skill. End your answer by explaining why you are passionate about investment banking and how your background can make you a great fit for the role. The interviewer wants to ensure that you have a realistic understanding about the role's demand and that your long-term career goals also align with the industry's competitive nature. To answer this, be specific. Talk about what excites you about investment banking, like the fast-paced environment, the intellectual challenge, and the opportunity to work on major financial transactions. Connect these interests to your past experience, mentioning a project or an internship that sparked your passion. It is also good to acknowledge the challenge, like long hours, high pressure, but emphasize that these motivates you to perform at your best. This is a technical question designed to test your understanding of various valuation methodology. Investment bankers typically use three main valuation techniques: discounted cash flow analysis, comparable company analysis, and transaction analysis. When explaining DCF, describe how you project futures for cash flow, discount them back to their present value using a weighted average cost of capital, and sum them up to get the entire enterprise value. For comparable company analysis, explain how to select a similar company, apply a relevant valuation methodology like EV by EBITDA or PE ratio. When discussing precedent transactions, mention how would you look at past M&A deals in the same industry to determine the valuation benchmark. Keep your explanation clear and structured. A follow-up or a standalone question generally being asked is, interviewer want to see if you can break down the entire process in a simple and a logical way. Start by explaining that you first forecast the company's free cash flow and over a set period of time like 5 to 10 years. Then you determine the terminal value either by using the Gordon growth model or an exit multiple. Next, you discount these cash flows and the terminal value back to the present value using the company's weighted average cost of capital. Finally, you sum up all of these value to come to the enterprise value and adjust it as per the debt to come out the overall equity value. This question ensures that you understand the capital structure and valuation. The equity value refers to the market capitalization or the total value of the company's share. Enterprise value, on the other hand, represents the total value of the firm, including debt, preferred stock, and non-controlling interest, minus cash and cash equivalent. Enterprise value is used when comparing companies regardless of their financing structure, when equity value is more relevant to the shareholder only. EBITDA stands for earning before interest, tax, depreciation and amortization. It is a measure of company's operating profitability. Because it excludes financing and accounting decisions, EBITDA is useful for comparing companies within the same industry. It is commonly used as a multiple like EV by EBITDA, which while not being a perfect measure, but can help you to understand the cash flow of the company and how the earnings are actually generated from the core operation. A tricky but frequently asked question is, there isn't a straightforward answer to this because it depends upon the industry, norm, growth, prospect, and market condition. For a high growth technology company, a PE of 10 might be considered low, whereas a stable, mature industry, it could be a normal or even high. It is always good to mention the factors like industry average, growth expectation, and risk profile before commenting about the PE ratio. It is possible, provided an example, like for example, you can talk about if the industry value is around 50 and company value is around 10, it might indicate undervaluation. Another important question that is generally asked is, interviewers over here expect you to be familiar with the methodologies, the pros and the cons. For example, DCF, comparable company analysis, precedent transaction analysis, and in some cases, leverage buyout analysis. Each of these methods has its own use cases, being able to explain when and why each case is actually used and what is the technical knowledge that is required. A frequently asked question is, now, interviewer over here wants to make sure that you have a solid understanding of these financial statements which are actively used in the industry. Net income from the income statement flows into the cash flow statement as a starting point for operating cash flow. Adjustment for non-cash expenses like depreciation and changes in working capital reconcile the net income to cash flow from operation. The ending cash balance from the cash flow statement then appears as a cash balance on the balance sheet. Similarly, return earning on the balance sheet increases by net income minus any dividend paid. Finally, a common finance related question that is asked is, the answer is that the cost of equity is usually higher than the cost of debt. This is because equity investors takes on more risk than the debt holder and therefore require a slightly higher return. Additionally, interest payments on debt are tax deductible, which reduces the overall net cost of debt. Understanding the concept over here is weighted average cost of capital. These questions are carefully chosen by interviewers to assess a candidate's technical knowledge, financial modeling skills, communication ability, and overall fit for investment banking. Preparing for them isn't just about memorizing definition, but about understanding their real world application and how you are able to explain them clearly. By mastering both the content and the delivery of these answers, you will increase your chances of success in the interview. Hope you find this video helpful. Make sure to like this video, share it with your friends who are also preparing for similar investment banking interviews. Thank you.